want to introduce you to Andrew Fairleigh.
Hey.
He is a great lender that happens to office right in the Keller Williams office with me. So if you prefer to work with a lender face-to-face, he's a great option. But they do have a application online if that's your preference as well. And I'm just going to ask you some questions, Andrew, that I know that some of these buyers are wondering, and are always, you always provide such good information. So when do you think that a buyer should start talking to a lender?
Honestly, like as soon as you start thinking about buying a home, you'd probably want to be talking to a lender just so you can see how close to being ready you are, and if you are ready sooner than you expected. Because you'd hate to find yourself in a situation where you want to buy a home this weekend, but it's going to take you a few months to get your credit where it needs to be or something like that. So if you're browsing through homes on HAR or Zillow, you probably also should be talking to a lender.
Okay. And do you ever help with someone who has, say, suggestions for someone who has no credit or working to improve their credit score?
Yeah, absolutely. Even if you're in a place where you think your credit's not that great, or maybe you don't have any credit at all, or just don't know where to start, we have tools. I have tools on my side that kind of show me what your options are to improve your credit on a short-term basis, right? If there's anything you can do to improve it immediately with what we call a rescore, or if there's any steps you need to take over the course of a few months. I also have a credit repair specialist that I could refer people to if they need a longer term plan. But yeah, absolutely. Even if you don't think your credit's good enough, it's still a good practice to see where you are and if there is anything you can do to improve it.
Right, because often your rate is tied to your credit score.
Absolutely,
So,
absolutely it is.
And what would you say would be the minimum credit score you have to get a loan?
Yeah, so on conventional, you need a minimum 620. Doesn't guarantee you'd get approved, just means you can try. And then on FHA, you need a minimum 580 to be able to do 3.5% down. And then if you have below a 580, we can sometimes go all the way down to 500 as long as you do 10% down. So if you're in the 600s, you're in a pretty safe place. If you're below 600, there's still opportunity out there for you to be approved, just may require more of a down payment.
Right. So there's a range, and the terms depend on your score. So, so why is it important to get a pre-approval letter?
Oh, well, two-part answer. One is just so that the listing agent or seller will even consider your offer, because a lot of times a listing agent may not even look at your offer if it doesn't have a pre-approval along with it, because they want to know that they're accepting an offer from somebody who can actually buy the house. But two, just for your own peace of mind, because you want to make sure that you're shopping at the right price range, that you're qualified to afford, that you're qualified to be able to close on. And then it also helps you understand what your monthly payment's going to be, what your estimated closing costs are going to be. I don't recommend that anybody go buy anything without knowing what the monthly payment is going to be or what the total cost is going to be, and that's what you can get with the pre-approval.
Right. Yeah. Okay. Definitely advantages to knowing what your buying power is, and then deciding what you're comfortable with.
Absolutely.
The monthly payment.
Yeah, absolutely.
Does it impact your credit if you shop around for a loan?
Yes and no. So the first time you apply with a mortgage company, with a lender, that first credit pull is going to be a hard inquiry and is going to drop your credit. How much varies from person to person, but after that, every mortgage inquiry, every credit pull by a lender for the next 30 days still only counts as that one time. So if you've already had your credit pulled and you're worried about another lender pulling it, it's okay as long as it was within the past 30 days or so. It's not going to hit you again.
Okay. Mm-hmm. And for the people who are renting, usually landlords looking for the rent to be them to have an income about 3 times the rent. What about with towards what is about the income that's allowed to go towards a payment?
I gotcha. Okay, so for income, we're going to use their gross monthly income, their monthly income before taxes, and for conventional, we're looking to see that all of their debts are only using up half of their income. So just under half, just under 50% of their total monthly income. And for FHA, just a little like 55, 56%. So just a little more than half. You have a little more wiggle room on FHA. So in that example, rent is looking for 3 times the monthly payment as far as income, whereas in a mortgage industry, it really depends on your debts. It could just be twice as much as your monthly, twice as much income as the monthly payment if you don't have a lot of debt. But yeah, so it really comes down to what other debt you have in your name and your total debt to income ratios. Yeah.
And is student loan debt included in that debt score?
Yeah, student loan debt is included, and then what we'll do is an easy kind of thing to think about is the total loan balance of the student loan. We do 1% or 0.5% of it as the monthly payment.
Okay. So how much can I expect to pay for a down payment and closing costs? How do you figure out how much cash you need?
Yeah, that's always a good question. So if you're doing FHA, you do 3.5% as a down payment. And if you're doing conventional, just expect 5% as a down payment. For first-time home buyers, they can do 3% with conventional, but just for calculating purposes, do 3.5 FHA and 5% for conventional. And then you'd add about $7,000 to $9,000 for total closing costs on top of that. So your down payment plus 7 or your down payment plus 8 is going to be a good estimate. Maybe not exact number, but a good estimate of what you might need to have to.
Depends on the sales price.
Yeah.
Right.
Yeah.
And your credit
All
score.
right.
Okay. You mentioned private mortgage insurance. Now, do you pay that for the life of the loan?
So on FHA, you would. Mortgage insurance, FHA, it's on there for life, regardless of the equity you put in there. On conventional, as soon as you get to 20% equity, or what you owe is 80% of the value of the home, then the mortgage insurance is removed. But yeah, on FHA, the mortgage insurance is on there for life.
Right. Now, I think that's part of the confusion why so many people think they need 20% down to buy a home.
Right.
But if you don't want to pay private mortgage insurance, which really isn't that much more,
No.
it's the infinitesimal amount compared to the whole package.
Compared to 20% down, right.
Then
Yeah.
you don't need the 20% down. But when you reach that goal,
Right.
and the value may change, which help you reach that a little sooner.
Absolutely. That's what I tell people is that it's a lot easier to get to that 20% equity through getting your home reappraised rather than it is just paying the monthly payments, because year to year the value of your home goes up, so you'll get to that 20% equity faster through just the increased value of your home rather than you paying it down.
Makes sense.
Mm-hmm.
Do any loans allow you to just waive the appraisal altogether?
So if you do conventional, you can waive your right to renegotiate, right, based on the appraisal, but the government-backed ones will not. You'll have to have an appraisal done if you're doing FHA or VA or USDA.
Okay. So one last question for you, Andrew.
Yeah.
What is the buy down?
So a buy down is you buy down your interest rate. So an interest rate isn't just like a jug of milk at the store where you go and you pick one out and it costs $3.50, whatever milk might be costing now, right? You can get an interest rate for par, which means no additional closing costs, or you can buy down up to 2 points, which is 2% of your loan amount, and that 2% gets added onto your closing costs. So one thing to consider when you're trying to think about buying down your rate is if you're going to be there for a while, and if you're not going to refinance for a while, then it is beneficial to buy down your rate because it does help lower your monthly payment, but it adds at the expense of closing costs. But if you're thinking within the next year or two, very rarely then is buying down a significant amount a good option, because you won't make back that investment. You won't lower your monthly payment enough to make back the amount that you spent on the rate itself. Yeah.
Okay. Well,
Yeah.
Thank you so much. We appreciate your expertise. Andrew always has all the answers, and he's fun to work with too.
I appreciate it. You as well. Yeah. All right.